My buddy Marcus makes $78,000 a year as a project manager. Last spring, he calls me super excited. Rayhan, I just got a brand new Jeep Grand Cherokee L, only $2,000 off MSRP. The dealer said it was an incredible deal. I paused because that same Jeep loses 20 to 25% of its value in the first year. A $58,000 car can drop to around $44,000 in just 12 months. If you're thinking about buying a new car in 2026, you need to watch this video first. Today, I'm breaking down the 7 models where prices are crashing the hardest right now. I'll show you the real depreciation numbers, why dealers are desperate, and exactly what to do so you don't lose tens of thousands like Marcus almost did. Stick around till the end. I'll give you a 5-step plan to buy smart and protect your money. After COVID, car prices went insane. People were paying over sticker. Now, inventory's back. Interest rates are high. Average new car payment is pushing $740 to $800 a month. The buyers said no thanks. Dealers are stuck with cars sitting on the lot for 90, 200, even 300 plus days. That pressure means bigger discounts for you, but brutal depreciation for whoever buys at the wrong time. Let's get into the 7 models that are losing value the fastest. Number 1 on our list is Tesla. And look, I know the Tesla fans in the comments are already typing, but stay with me here because the data is the data. The Tesla Model S has been clocking depreciation rates of 15 to 17% year over year in the used market. That's not a prediction. That's what Edmunds, Car Gurus, and IC Cars have been tracking in their depreciation indexes. Now, here's why this matters in 2026 specifically. Tesla has been on a price war with itself for 3 years running. Elon Musk's strategy of cutting new car MSRPs to drive volume, smart for Tesla, brutal for anyone who bought a Tesla 18 months ago at the old price. Here's a real example. A 2022 Tesla Model S long range was selling for around $104,000 new. Today, you can find comparable used versions for $58,000 to $65,000, a drop of nearly $40,000 in under 12 months. Now, you might be thinking, Rayhan, but Tesla's a tech company. They keep updating the software. The car gets better over time. And that's a fair point. The over-the-air updates are genuinely cool. But the problem is, a software update doesn't change the market price. When a new Model S comes out with better range and newer hardware, your old one becomes less desirable, period. For buyers, though, this is an incredible window. New Model 3 leases in April 2026 are coming in around $99 to $109 a month effective cost with dealer incentives in competitive markets. That's almost absurdly cheap for what you're getting as a vehicle. The move, if you're renting, don't buy a used Tesla at what you think is a discount because it may keep dropping. If you're set on Tesla, negotiate hard on new or certified pre-owned with a warranty, and understand you are not making a wealth-building decision. You're making a transportation decision. Know the difference. Okay, model number 2 might surprise you. The Volkswagen ID.4. This car has some of the highest days of supply inventory of any vehicle currently on sale in America. We're talking reports of 200 to 300 days of supply sitting on lots. The industry benchmark for a healthy, balanced market, about 60 days. So let's think about what that means. Volkswagen made a bunch of these, dealers ordered them, and not enough people are buying them. Why? A few reasons. The software, which VW has publicly acknowledged, has had issues. The charging infrastructure, particularly for non-Tesla EVs, still makes some buyers nervous. And frankly, the value proposition against a similarly priced Toyota RAV4 or Honda CR-V just isn't there for the average American family yet. But here's where it gets really interesting for you as a buyer. Dealers on a model with 300 days of supply aren't negotiating, they're pleading. I've seen reports of $6,000 to $9,000 off MSRP on ID.4s from dealers who just want to free up floor space and stop paying that floor plan interest I mentioned earlier. Now, should you buy one? That's the real question. And I want to be honest with you here. I'd be cautious. Not because it's a bad car exactly, but because anything with that much inventory pressure tends to keep depreciating. If you buy it today and the market clears, your resale in 2 years may be brutal. If you lease it, different story. You're capping your exposure. Let the residual value risk sit with the leasing company. The move? If you need an EV and you're in a lease mindset, the ID.4 deals right now are genuinely remarkable. If you're buying to own, proceed with extreme caution and check the resale trajectory first. Number 3, the Ford Mustang Mach-E. I want to talk about this one because it's a case study in what happens when a brand makes a brave product bet and the market doesn't quite respond the way they hoped. Ford put the Mustang name on an all-electric SUV. Purists were angry, sales were okay but not great. And now in 2026, with EV incentives shifting and competition from every direction, Hyundai, Kia, Tesla, GM, the Mach-E is sitting in a tough spot. Used Mach-E prices have dropped significantly. First-generation models that sold for $54,000 to $58,000 new are now trading in the $28,000 to $34,000 range used. That's a 40+% haircut in some cases. And Ford is currently offering aggressive incentives on new ones too. We're talking 0% financing plus cash back on select trims, which effectively lowers the real cost of ownership considerably. Look, here's the psychology lesson buried in this one. When Ford slapped the Mustang name on this EV, they were leveraging brand equity to sell a new concept. That's smart marketing, but here's what most people don't realize. Brand nostalgia doesn't protect resale value when the underlying product category is oversupplied and rapidly evolving. The Mustang badge didn't protect this car's value. The fundamentals of supply and demand did. And right now, supply is winning. The move? If you're a Ford loyalist and you want an EV, the certified pre-owned Mach-E market is legitimately attractive right now. You can get a 2022 or 2023 model well under $30,000 with CPO warranty protection. That's where the real value play is. This brings me back to my friend Marcus. Number 4, Jeep, and more broadly, Stellantis models, which includes Dodge, Chrysler, Ram, and Jeep. Now, I want to be fair here. Jeep makes genuinely capable off-road vehicles. People love them. They have a cult following. But love and financial wisdom are two different things. Here's what the data shows. The Jeep Grand Cherokee L, one of Stellantis' flagship 3-row SUVs, has been clocking first-year depreciation of 20 to 25% in several market analyses. That means on a $58,000 purchase, you're looking at losing $11,600 to $14,500 in year one alone. Compare that to a Toyota Highlander, which typically loses 12 to 15% in year one, or a Honda Pilot, similar story. The difference is real money. Sometimes $5,000 to $8,000 in year one alone, just because which badge is on the hood. And here's the macro context that makes this worse right now. Stellantis as a company has been struggling. Plant closures, leadership changes, sales drops. When a brand struggles institutionally, it tends to put downward pressure on used vehicle values across the board. Lenders get more conservative on financing, rental fleets order less, and suddenly the used market gets flooded.
Now you might be thinking, but Rayhan, I've wanted a Wrangler my whole life. Are you telling me not to buy it? And look, I'm not here to tell you what to want. I'm here to help you understand what things cost. If a Wrangler brings you genuine joy and fits your lifestyle, make that call, but make it with clear eyes on the financial reality. You are likely to lose a significant chunk of that purchase price quickly, and that's the real price of ownership, not the sticker. The move? If Jeep or Stellantis is your thing, negotiate hard right now. Dealers are motivated. Cashback deals of $3,000 to $7,000 on several Jeep models have been appearing in market reports. And heavily consider a used model from 2021 or 2022 where someone else already absorbed that brutal first-year drop. Number 5, Nissan, specifically the Altima and the Ariya EV. This is the hidden one on this list because while everyone talks about Tesla depreciation and Jeep resale value, Nissan quietly has some of the worst long-term depreciation numbers in the entire industry. The Altima, which sells for about $27,000 to $31,000 new, has a 5-year depreciation rate that some analysts peg at 55 to 60%. That means in 5 years, a $30,000 Altima is worth roughly $12,000 to $13,000. For context, a Toyota Camry in the same class loses closer to 35 to 40% in 5 years. On similar price points, we're talking a $6,000 to $7,000 real-world difference in what you'd pocket if you sold both cars after 5 years. That's not a rounding error. That's a vacation, a stock market contribution, a chunk of an emergency fund. And why does Nissan depreciate so badly? A few compounding factors: lower perceived quality in recent years compared to their peak, brand reputation challenges, heavy use in rental fleets which tanks used market confidence, And now, financial pressures on the company itself, including plant closure announcements that spooked the market. The Aria EV, same problem, different wrapping. It entered a market already crowded with more established EVs and immediately started losing value quickly. The move? If budget is your priority and you need reliable transportation, a used Nissan with 30,000 to 50,000 miles can be a reasonable budget buy, precisely because someone else already absorbed all that depreciation. But buying new, you're starting a financial race with a 15-pound weight vest on. Now, Model 6, and this one is the most nuanced on the list, so stay with me. The Korean EVs, particularly the Hyundai Ioniq 6, the Kia EV9, and the closely related Honda Prologue, are experiencing an interesting phenomenon. These are genuinely good cars. The Ioniq 6 won multiple Car of the Year awards. The Kia EV9 is a legitimately impressive three-row EV, but right now, the EV market as a whole is cooling faster than manufacturers anticipated, and the result? Incredible incentives. We're talking $7,500 to $10,000 in cash incentives on several of these models. The Kia EV9 has dealer incentives stacked on top of federal tax credits that bring the effective transaction price down dramatically from MSRP. The Honda Prologue has been trading at roughly 8 to 9% below sticker. Here's the psychological shift that's happened in the EV market. Early adopters, the Tesla owners, the tech-forward buyers who lined up in 2020 and 2021, they already bought. Now, manufacturers are trying to reach the mainstream buyer, and the mainstream buyer is more price-sensitive, more range anxiety prone, and less willing to pay a premium for green branding alone. So, prices have to drop to reach them.
This is actually a classic technology adoption curve playing out in real time in the auto industry. And here's the thing about being in the early majority or late majority of a technology adoption curve. You often get the best price to quality ratio. You benefit from all the early R&D, but you're not paying the early adopter premium. The move. If you're EV curious but have been waiting, this might be your window. The combination of improved charging infrastructure, compelling vehicles, and heavily discounted prices makes the math work better today than it has in years. But, and I can't stress this enough, lease first if you're unsure. The technology is evolving quickly enough that locking yourself into a 5-year loan on today's tech carries real risk. All right, number 7, and this one is the most extreme example on this entire list. Luxury EVs and niche luxury brands. Specifically, Maserati, particularly the Grecale and Levante, and on the EV side, the Lucid Air and Lucid Gravity. Look, let me be direct. If you're buying a Maserati as a financial investment, we need to have a longer conversation about fundamentals. But if you're considering one, or if you know someone who is, hear this. Maserati models are routinely sitting on dealer lots for 200 to 400 days. The industry average is 60. We've already established what that means. The Lucid Air, a genuinely stunning EV with the longest range of any electric car on the market, has been seeing effective lease and pricing deals that amount to a 20 to 25% reduction from where it was priced just 18 months ago. The Lucid Gravity SUV, their newest entry, launched with enormous fanfare, but immediately faced a market unwilling to pay $80,000 plus for an unproven brand. And here's the biggest depreciation stat of this entire video. The Lucid Air, a car that started at around $87,000 MSRP in some configurations, you can now find used examples from 2022 and 2023 for $38,000 to $45,000. That is a $40,000 to $50,000 haircut in 2 to 3 years. Let me say that again. Someone paid $87,000 for a car. It is now worth $40,000. That $47,000 difference? Gone. Faster than almost any other asset class you can buy, it evaporated. Now, here's the uncomfortable truth I want you to sit with. That $47,000 loss, invested in a diversified index fund at a historical average return of 7 to 10% per year, in 20 years, that's somewhere between $181,000 and $317,000. That's retirement money. That's generational wealth money. That's college tuition money. And someone handed it over because a car looked good in their driveway
driveway. I'm not saying don't enjoy life. I'm not saying vehicles aren't important, but I am saying understand the real cost of what you're buying, because the sticker price is never the real price. Okay, I've given you the 7 models, but I want to spend a few minutes on why this keeps happening, because it's not a knowledge problem really. Most people know cars depreciate, but they keep buying them wrong anyway, and it comes down to 3 psychological traps.
Trap 1. Identity spending. We buy cars that represent who we want to be, not what we actually need. The Jeep is adventure and freedom. The Tesla is innovative and status. The Maserati is a success. And dealers, who are some of the best salespeople on the planet, know this. They're not selling you metal and glass, they're selling you a version of yourself. And that version comes with a monthly payment you might not have fully thought through. Here's what most people don't realize. Your car does not build your identity. Your net worth does. The person driving a 5-year-old paid-off Honda Accord with $200,000 in investments is in a fundamentally different financial position than the person in a brand new Mach-E with a $687 a month payment and 0 savings. One of them is building wealth. The other is building the appearance of wealth. Trap 2. The monthly payment illusion. Ugh, this one drives me crazy. Can I afford this car becomes can I afford this payment? And those are completely different questions. $650 a month sounds manageable, but $650 a month over 60 months is $39,000. And if that car depreciated 50%, which some of the cars on this list will, you just paid $39,000 for something worth $20,000. You spent $19,000 more than the car is worth. That's the real transaction, not the monthly payment. Trap 3. The sunk cost of comfort. Once you're used to driving a nice car, it becomes really hard to downgrade. This is why people keep rolling negative equity from one car loan into the next. I'll trade it in and just add what I owe to the new loan. Each time they do, the hole gets deeper. I've seen people with $15,000 to $20,000 in negative equity rolled into a new vehicle purchase. They think they bought a car, they actually bought the ghost of the last car they couldn't afford, plus a new one. All right, let's end with the actual moves, because I don't believe in just telling you what's wrong. I want to give you a path forward. Step 1. Run the real ownership cost before you run to the dealership. Get on Edmunds or CarEdge. Look up the true cost to own for any vehicle you're considering. That number includes depreciation, insurance, maintenance, fuel, and financing. All of it. It will often be $3,000 to $8,000 per year more than you think. Do this before you fall in love with a car in a showroom. Step 2. Use the supply data as your negotiating weapon. Before you walk into any dealership, look up the days of supply for that specific model on Car Gurus or Edmunds. Anything over 90 days, you have leverage. Ask for it. Start your offer 8 to 12% below MSRP on high inventory models. You will often get surprisingly far. Step 3. Separate your transportation decision from your financial plan. You need a vehicle. Fine. Decide what you actually need. Commute, family size, practical requirements. Then find the most reliable, reasonably depreciation-resistant vehicle that meets those needs at the lowest total cost of ownership. It is almost always a used Toyota, Honda, or Mazda with 30,000 to 60,000 miles on it that someone else already drove through the steepest part of the depreciation curve. Step 4. If you want something on this list, lease it. If you genuinely want one of the 7 models we covered today, whether it's the Tesla, the Mach-E, or the Ioniq 6, lease it, don't buy it. Cap your exposure, let the residual risk sit with the bank. Get the car you want, enjoy it, return it when it's done, and don't sit on a depreciating asset you can't easily exit. Step 5. Take the depreciation dollars and invest them. This is the real compounding move. If you choose a used Camry at $22,000 instead of a new Grand Cherokee at $58,000, that's a $36,000 difference. Even if you finance it, your monthly payment is dramatically lower. The delta? Put it to work. Index funds, real estate, a business, something that goes up in value. Let cars be transportation, not your biggest monthly expense and fastest depreciating assets simultaneously. Look, I started this video with my friend Marcus. Last time I talked to him, he'd had his Grand Cherokee for about 14 months. He'd already gotten 2 quotes from dealers to trade it in, and both came in nearly $11,000 less than what he paid. He told me, Rihan, I wish I'd watched your video before I bought it. And that's the whole point. Not to make anyone feel bad, not to say you can't enjoy a nice vehicle, but to make sure that when you're standing in that showroom, when the salesperson is doing the payment calculation on that little piece of paper and sliding it across the table, you know what you're actually agreeing to. You know that the monthly payment isn't the cost, the depreciation is the cost. You know that identity spending is real and it's expensive. And you know that right now, in this exact market, there are incredible opportunities for buyers who are informed and strategic. The 7 models we covered today are either traps or opportunities. Which one they are depends entirely on how much you know going in. Go in knowing. If this video helped you, hit that like button. It genuinely helps other people find this content. And if you've got a friend about to make a big car purchase, share this with them first. It might save them tens of thousands of dollars. I'll see you in the next one.